Okay, so hello and welcome to today's session. Now, in today's session, we're going to attempt Mar-Jun 2023 attempt question number 1. That's Joshua Company. I'm reading the exhibits. Please follow them. Exhibit number 1 states, Joshua Company is a listed leading fashion retailer with stores based in flagship retail centers nationwide. For many years, Joshua Company has been highly popular, but its financial performance has suffered recently due to problems associated with its online operation. These problems are causing concern for the company, institutional shareholders. Okay, so the question states that Joshua Company is a leading fashion retailer. Okay, the company is a leading fashion retailer. With stores based in flagship retail centers nationwide, it has nationwide stores. For many years, Joshua has been highly popular, but its financial performance has suffered recently due to online operation. Problems are causing concern for shareholders. Online rivals have emerged in recent years and are quickly reducing Joshua's market share. These companies have also successfully diversified into other areas such as household furnishings once they have established a well-known brand. Joshua recently attempted to acquire one of these online rivals, Fraser company, but neither company's shareholders approved the deal on the grounds it was unlikely to create value. Following a series of profit warnings, there has been ongoing media speculation that Joshua is attracting takeover interest. There has been no approach made so far, but Joshua directors are concerned about the implications for their future in the company. Joshua's chairman would like to discuss defense strategies at an upcoming board meeting, particularly the suggestion that Joshua should defend itself against a takeover by improving its own takeover offer for Fraser. The rationale for this suggestion is that it would be much more difficult to acquire an enlarged Joshua company. In addition, this would also introduce a risk diversification benefit into Joshua's operations. So, summary, paragraph number 1. Joshua is a listed fashion retail outlet. It has stores nationwide. It has been highly popular, but financial performance has suffered due to online operation, and this is causing concern in shareholders. Online rivals have emerged in recent years and are quickly reducing Joshua's market share. Because of rivals, your share is going. Companies have also successfully diversified into other areas. Okay, Joshua tried to acquire one of these rivals, Fraser, but neither company's shareholders approved the deal. Neither company means no shareholder group. Neither Joshua nor Fraser group approved this deal because they thought it is unlikely to create value. Now, following a series of profit warnings, there are media speculation that Joshua might be acquired by someone. It is attracting takeover interest. There has been no approach made, but Joshua's directors are concerned. Joshua's chairman would like to discuss defense strategies. He thinks that Joshua can defend itself by improving its offer for Fraser. It should acquire Fraser with an improved offer. The rationale reason for this is that if you acquire Fraser, become an enlarged Joshua company, then people may not acquire you because you are a now enlarged company. Okay. In addition, this would also introduce risk diversification. Okay. Now, acquisition of Fraser. Joshua's funding options have deteriorated significantly since last year's cash offer for Fraser company was rejected. It no longer has the cash reserves required to fund another cash offer, and the shareholders are unlikely to agree to a rights issue so soon after the last attempt, which also ended in failure. In addition, Joshua's gearing exceeds the industry average and the company is close to breaching one of its bank covenants. The CEO has therefore suggested a new offer is made for Fraser based on share-for-share exchange. Funding options have deteriorated significantly. Okay, it no longer has the cash reserves. Okay, no right issue will be agreed. Gearing has exceeded industry average because company is now also close to breaching one of bank covenants. CEO has suggested a share-for-share exchange. You are no longer going to do a cash offer. You don't have cash. Your gearing is also high, so no debt, no right issue, share-for-share exchange. Following information is available, including brief extract from both companies' most recent annual report. Joshua, the acquirer, and Fraser, the acquiring company. Market value of equity, asset beta, dividend, ordinary shares. Okay, it was 40 million shares, it was 10 million shares. Cost of capital. Joshua's post-acquisition asset beta, post-acquisition, after acquisition, can be assumed to be a weighted average of both companies' pre-acquisition asset betas, weighted in proportion to their market value of equity. Your post-acquisition asset beta will be weighted average of both in proportion to this market value of equity. The weights will be of market value of equity on these asset betas. Okay. The board intends to maintain the company's existing debt to equity ratio of 30-70 based on market value and expects a pre-tax credit spread on Joshua's debt to remain 410 basis points above the risk rate. So debt to equity ratio will remain constant at 30-70. Will remain at 30-70 based on market value, and spread will be 410 basis points above risk rate. Post-acquisition cash flows. According to Finance Director, Joshua will earn PBIT of 27.2 million first year, growing by 5% per annum following 3 years. It is assumed TAD will be equivalent to amount of investment working capital, investment in assets of 2.7 million 1 year, and 2.3 per dollar one increase in revenue. It is expected acquisition will create tax synergies worth 9.2 million per year in each of first 4 years. From 5 year onwards, free cash flow are expected to grow annually by 3% for the foreseeable future. Share for share exchange and post-acquisition dividend. CEO's proposal for a share for share exchange will involve 1 Fraser share being exchanged for 3 Joshua shares. Based on last year negotiations, board believes it is a good understanding of Fraser's expectations. You have therefore been asked to incorporate a minimum acquisition premium of 35% into your analysis, which is the same premium which was requested last year. Fraser's founder and majority shareholder is unlikely to approve the acquisition offer on terms which would lead to a reduction in annual dividend. However, Joshua's debt includes a covenant restricting dividend payments to 25% of each year's free cash flow to the firm. The board has therefore asked for an evaluation of the impact of proposed terms on next year's forecast dividend for both company shareholder. So founder and majority shareholder doesn't want an acquisition which would lead to reduction in dividend. But Joshua's debt includes a covenant that dividends cannot exceed 25%. So you are being asked to give an evaluation of proposed terms on forecast post-acquisition. Okay. Both companies pay tax at 18%, RF 3.7%, premium 8.1%. Okay. Third exhibit, share buyback. As yet, there have been no formal takeover offers for Joshua. However, boards want to be fully prepared in case it changes, particularly if their own takeover of Fraser is not viable. Directors have been attending a series of webinars on alternative takeover defenses and would like to discuss their findings at next week's board meeting. Topics to be discussed include possibility of using share buyback as a defense tactic. This would involve Joshua buying and then cancelling some of its own shares. Joshua CEO has asked for advice on the credibility of such a defense and would like to discuss the effect on company's EPS, cost of capital, and share price, among other issues, in the context of company's liquidity problems and a further bank covenant which has imposed a restriction on when assets can be disposed of. There are no offers, but Joshua wants to be fully prepared. Directors have heard of something that you can buy share buyback as a defense tactic. Joshua will buy their shares, own shares, and cancel. CEO wants advice on credibility of this and would want to discuss the effect on EPS, cost of capital, share price, okay, and bank covenant. Okay. These are all the things. Obviously, we will read them slowly as well once we are going for individual requirement. But first was Joshua's data, profitability falling, online business, competitors, rivals emerging. You want to acquire Fraser acquisition data, share buyback data, requirements. Okay. So discuss the agency problems created by Joshua's proposed takeover of Fraser as a defense. Joshua wants a takeover of Fraser as defense and risk diversification strategy, and explain how these could be mitigated. So agency problems created by Joshua's proposed takeover of Fraser as a defense and risk diversification strategy, and explain how these could be mitigated. If you go here, following a series of profit warnings, there have been media speculation that Joshua is attracting takeover interest. There has been no approach made so far. Joshua's directors are concerned about implications of their future in the board meeting, particularly suggestion that Joshua could defend itself against takeover by improving its takeover offer for Fraser. Rationale for this, it would be much difficult to acquire Fraser as an enlarged Joshua. In addition, this would also include a risk diversification benefit into Joshua's operations. Okay. So the thing is that Joshua is having problems, okay, and shareholders are concerned. Rivals have emerged. Joshua attempted to acquire rival Fraser, but neither company's shareholders, neither Joshua nor the Fraser company shareholders approved this, okay. Now, after profit warnings, they want another takeover bid for Fraser on improved terms on the grounds that this would act as a defense, okay, and improve the takeover bid for Fraser so that enlarged Joshua would be difficult to acquire, okay. Discuss the agency problems created by Joshua's proposed takeover bid of Fraser as a defense. So Joshua wants to take over Fraser as defense. What will be the agency problems created and how these could be mitigated? Okay. First, you need to understand the agency relation for this. Agency relation is that directors are agents of shareholders and should always work for shareholder wealth maximization. If directors are not working for shareholder wealth maximization, it is said that there is agency problem. Okay. Now, in this scenario, agency problem seems to be getting created. Shareholders are concerned on profits. They have already disapproved the takeover bid of Fraser company. But after media speculations, that Joshua might be taken over, the directors are concerned about their future and want a defense strategy which is improve takeover bid for Fraser so that Joshua gets enlarged and becomes difficult to get acquired. To protect their own interests, they are raising offer for Fraser, which goes against shareholders' interests, hence creating agency problem. Okay, agency problem simply means directors and shareholders are not going on one page. Directors are agents. They should always work towards shareholder wealth maximization, same page. Okay, this is agency relation. But when directors are not working for shareholder interests, both interests are different. This is agency problem. Okay, here agency problem is getting created because shareholders are concerned on profits. They've already rejected a bid for takeover of Fraser. They think it would add value. But when the media speculation says that Joshua might get acquired, so directors are feeling worried what will happen about our job security. So they are now wanting to increase Fraser bid as defense so that Joshua becomes enlarged and no one acquires us and our job remains same. This is personal benefit, not shareholder benefit. So this is agency problem. Okay. So this was the requirement, discuss agency problem created by this and explain how these could be mitigated. This problem can be mitigated by convincing shareholders that this acquisition will create synergies, will provide long-term benefit to company, will increase shareholder wealth in long term, and will diversify risk. Unless shareholders are convinced and they are on the same page with directors, agency problem is unlikely to be minimized. Okay, so please copy this. Okay, so let's continue Joshua Company. We have already done the first requirement, agency problems created by Joshua's takeover, and explain how these could be mitigated. So we wrote an answer about agency relation here. Now, Part B, report for Board of Directors, post-acquisition WACC, additional value to shareholders from Joshua's proposed acquisition of Fraser, shareholder wealth before and after acquisition by calculating percentage in equity, board of any concerns, and credibility of CEO suggestions. Okay, let's start. So since you have to make a report, you from date, subject, introduction. Board of directors. So if any position is mentioned, you can mention that. Subject is proposed acquisition of Fraser. Introduction. This report, all requirements, calculates post-acquisition weighted average cost of capital it then estimates additional value to shareholders from proposed acquisition of Joshua. It then compares shareholder wealth before and after acquisition. It then advises board बोलो. It then advises shareholders of any concerns. May have with the acquisition. Finally, It discusses credibility of CEO's alternative suggestion of buyback as takeover defense. Okay. Now, after everything, we have told you that every requirement must have a separate heading, and if it's a calculation, refer to appendix. If it's a discussion, continue here. Okay. So post acquisition WACC additional value to shareholders. Then shareholder wealth before and after acquisition. Now, since you know that every requirement has a separate heading, so if it's a calculation requirement, we will refer to appendix spreadsheet. If it's a theoretical requirement, then we can continue here. So post-acquisition WACC seems to be a calculation requirement, so we will write appendix one shows post acquisition WACC Okay, so appendix one shows post-acquisition WACC, which is what we will find. So now we should refer to appendix one. Additional value to shareholders also is a calculation requirement. So appendix two shows additional value to shareholders as okay. So in appendix one, post-acquisition WACC, let's start. One post acquisition WACC. Okay, let's refer to the information. Joshua's funding options have deteriorated. Information is available. Joshua and Fraser's market value of equity is given, asset beta is given, dividend is given, ordinary shares is given. Post-acquisition asset beta can be assumed to be a weighted average of both companies' pre-acquisition asset betas weighted in proportion to market value of equity. Now, post-acquisition asset beta is the weighted average of pre-acquisition asset betas weighted in proportion to market value of equity. And debt to equity ratio will be 730-70 and a pre-tax spread of 410 basis points above the risk-free rate. Okay. So now post-acquisition cash flows, and here is the tax rate given: RF 3.7%, market premium 8.1%. Okay, so let's start post-acquisition WACC. Debt to equity ratio will be 30/70. Okay, so the equation of WACC post-acquisition is KE into E over E plus D plus KD1 minus T into D upon E plus T. Okay, so for post-acquisition WACC, four things are required: ED, KE, KD, 1 minus T. Okay, so let's start here. Debt to equity ratio 30/70, 30/70. Okay, K is RF plus RM minus RF beta equity. Okay, and KD1 minus T, it's RF plus spread because the spread approach is given. So pre-tax spread. So it's RF plus spread pre-tax. 410 basis points, 4.1%, and risk-free rate is 3.7%. So KD is the RF plus spread. So RF is what do you say, 3.7%, plus spread is 4.1%. %7.8%. Okay. And after tax simply means you can do J5 steric after tax, 18% tax. It's 6.4%. Okay. Now for KE, I'm doing a proper working here. KE is RF plus RM minus RF, the premium into beta equity. Okay, so let's find the risk-free rate. 3.7%. RM minus RF, the premium. %8.1. Beta equity. Beta equity is through an equation. Beta asset is equals to beta equity into E upon E plus D, 1 minus T plus beta debt into D okay. Now for beta equity, you would be needing a beta asset and you know the E and D. So what is the beta asset of this combined company? It's mentioned that beta asset post-acquisition will be weighted average of both companies' pre-acquisition asset betas, weighted in proportion to market value of equity. Okay. And market value of equity is 0.102 and 56. So let's find post-acquisition beta asset. You have studied this in classes that post-acquisition beta asset is the sum of pre-acquisition asset betas 0.85 and 1.18 into their weights of market value of equity. 0.85 plus 0.18, sorry, 1.18. But they will get weighted by market value of equity. So market value of equity is 102 for this out of 102 plus 56, 158. 102 upon 158. For Joshua. And for other, it's 1.18 into weight of market value of equity, 56 divided by 158, 102 plus 56. Okay, so this gives you answer as 0.97. This is the post-acquisition beta asset. Now you have the beta asset of post-acquisition. You need to find beta equity here. And E and D are already available to you. It's 70 divided by 70 plus 30, 1 minus 0.18. So let's get the post-acquisition beta equity as 1.31. Right. RF plus RM minus RF into beta equity gives you 0.037. RF plus RM minus RF, the premium, 0.081 into the beta equity, 1.31. This is 14.311%. And KD is 1 minus T is J6. Okay, everything is there. You just have to find WACC. RF, sorry, WACC KE is 14.3%. So B7, steric, E over E plus D, that means 70%. Plus KD1 minus D, that's B8, steric, 30%. So WACC is 11.9%. This is the post-acquisition WACC. If you have any queries, you can ask me, else you can copy, and you have to copy two things now. One, this post-acquisition WACC, and one, this spreadsheet. Okay, so let's just make them a bit small. Okay. Okay, so first you need to copy this, the word processor, and then you will copy this spreadsheet data. Okay, so please copy both of these things. Okay, so I hope you have done this weighted average cost of capital post acquisition. Now let's move forward to the next requirement. Additional value to shareholders from Joshua of proposed acquisition. This additional value I've already taught you in multiple questions. It's the combined value less individual values. You get additional value less premium paid you get for the new company shareholders. Okay, so this has been a very, very common requirement in the exams. Additional value to shareholders from Joshua's acquisition of Fraser. Additional value to shareholders from acquisition. I really like this requirement as well because it's been so much repetitive that additional value is always the difference of combined value less individual values. You get additional value. So how we will compute value of the combined value, combined company, sorry. According to finance director, PBIT of 27.2 million first year after acquisition, growing by 5% per year and following 3 years, TAD equal to working capital, investment in assets of 2.7 required, and then 2.13 million for every $1 increase in revenue in PBIT from year 2 to 4. Acquisition will create synergies of 9.2 billion per year in each of first few years. And from year 5 onwards, free tax cash flows will grow by 3% to perpetuity, that's FCF. Okay. And since WACC is given, so you will use the FCF to company. So additional value to shareholders from acquisition, it's simply the combined company value less value of Joshua less value of Fraser. You get additional value created. Okay, so let's find the combined company value through FCF to company method. Okay, when you apply the FCF to company method, because WACC is given, you know the format. It's sales less cash cost, TAD. You go to operating profit, also called PBIT. Then you pay interest, you get PBT. Then you pay tax. If PAT is given, you can write that. If not, then no need to write that. Add back TAD less investment in NCA less investment in working capital. Okay. You get FCF2 company. Then you apply discount factor, which is WACC. You get present value, then present value of all future FCF gives you value of company less value of debt. Okay, you get value of equity. This is the format of FCF method. The combined company value will be found through FCF method as per the data given. Okay. So if we find out the combined company value through FCF method, PBIT operating profit 27.2 million first year and then 5%. So you will write 27.2 in first year. and then rising by 5%. And you can drag it. Mistakenly, I wrote in place of sales. I will just correct it. This is operating profit, the PBIT. Okay, cash cost area and operating profit. Interest doesn't come. You get PBT. Tax. What is the tax? 18%. So it's I-26 into 18%, and I have to show it as negative. Add back TAD investment and working capital are the same. TAD is equivalent to working capital, so one thing added, one thing deducted, it will be the same. Investment in NCA, what does it say? 2.7 million first year and 2.13 per dollar increase in PBIT. So 2.7 million in first year. And then 2.13 per dollar increase in PBIT. So PBIT is increasing by how much? J23, sorry, J24 minus I24. This is the increase in PBIT. 2.13 of this. Okay. Then increase in PBIT is K24 to J24, 2.13. And then L24, K24 to 2.13. Okay. You get FCF2 company. Okay, this is what you got, FCF2 company. People might be wondering why I didn't include this after tax synergy is 9.2 million in first 4 years. Okay, I will just shortly answer that, but I haven't included that. So discount factor WACC is 11.94% or 12%. So at 12%, it's 0.893, 0.797, 0.712, 0.636. After 4 years, that means 5 to infinity. What is happening? The FCF are growing, sorry, by 3% for the foreseeable future. So increase them by 3% for the foreseeable future. Okay, discount factor WACC, you take last discount factor, L33 divided by WACC minus G. So WACC is 0.12 minus G is 0.03. You get present value. It's I32 into I33. So total present value of all future FCF is the sum of I-34 to M-34. This is the value of total present value of all future FCF. Okay, this is called value of company. This present value of all future FCF. This is called value of company. Now you need to deduct value of debt to get value of equity. Now, I did this without synergy benefits, right? Because synergy benefits are also there. 9.2 million each of the first 4 years, okay? Had I written the synergy of 9.2 here, pay attention please, 9.2, 9.2, 9.2, 9.2, my answer would have been wrong, because see, in this FCF calculation, then synergy would also be included. And then in future, for year 5, you grow this by 3%, the synergies also come, whereas synergies are not coming after 4 years, right? It's only coming till 4 years. So if you include synergy here, it will get included in FCF working. And when you increase this last year's FCF by 3%, it will come 5 to infinity as well, whereas it is not coming. So synergy should not come here. Okay, you get present value of all FCF, that's the value of company. Okay, now you need to add value of synergy. Okay, now synergy is 1 to 4, 9.2 million. Okay, discount factor, WACC. Present value. Okay, total present value of synergy is the sum of B35 to E35. This synergy is also a benefit, so you add it. Adding both of them gives you value of company in total. Okay, you can deduct value of debt, that's 30%. You can get value of equity, 70%. Pay attention to what happened to this synergy thing, because the thing is that things were quite straightforward, that additional value to shareholders from acquisition is the combined value less individual values, you get combined value, additional value created, sorry. But the problem is that you get FCF, discount factor, WACC, present value. Total present value of all FCF is the value of company. But I didn't include 9.2 million synergies in it. Why? Because synergy firstly doesn't come in FCF format, but by chance, if I include even it here, this will get impacted in FCF, and in year 5 to infinity it will come also, whereas synergy is not coming year 5 onwards. So just leave it and deal it separately, present value of all FCF, then value of synergy separately, total present value. You get value of company less value of debt, value of equity. Now combined value of equity is I-38, sorry, I-39, okay, less individual value of Joshua is given 156. Sorry, 102 and 56. 102 is Joshua and 156 is Fraser. 56. You get additional value created as okay, 21.362. But from this, you need to pay premium to Fraser shareholders. Fraser shareholders are demanding a premium of 35%. It's written in the question that their shareholders are demanding a premium of 35%. So premium to Fraser is 35% of their equity value. So additional value for Joshua shareholders will be B23 plus B24. This has been a very, very normal part in many examination attempts, additional value created. Simply combined value less individual values, you get additional value less the premium paid, additional value for the buying shareholders. Okay, hope this is clear to you. Please copy. Okay, so after completing this additional value from acquisition, let's move towards the further parts. Now it's a 6-mark requirement. Compare shareholder wealth before and after acquisition by calculating percentage change in equity value and next year's dividend income for both companies. You have to compare shareholder wealth before and after acquisition. How it has provided you the solution by calculating percentage change in equity value and next year's dividend income for both company shareholders. Okay, so first we have to find percentage change in equity value for both shareholders and then percentage change in dividend income for both company shareholders. Okay, so let's just open the spreadsheet. First, we will find percentage change in equity value for both company shareholders. Joshua and Fraser. And then we will go for percentage change in dividend for both group of shareholders. Okay, so first percentage change in equity value for both shareholders. Now it's simple percentage change in equity value for both shareholders. Equity value before acquisition and equity value after acquisition. So equity value before acquisition was 102 and 56. 102, 56. Okay. Equity value after acquisition. Okay. Now, what is the equity value after acquisition? So equity value after acquisition is this. 179.36. This is what we have done here. Equity value after acquisition. 179.362. But this 179.362 is the equity value after acquisition for both companies, the combined company. 179.36. Okay, this is the equity value after acquisition for both companies. It's for the combined company, right? Now, what is the equity value after acquisition for individual companies? How you will split it? Okay. Now, what you can do is here that the proposal of acquisition is that one Fraser share will be given for 3 Joshua shares. Now, one Fraser share for 3 Joshua shares. Number of shares of Joshua are 40 million. Number of shares of Fraser is 10 million, right? So number of shares of Joshua is, I guess, what do you say, 40 million. And number of shares of Fraser were 10 million, but they are cancelled. And 3 shares are issued for 1 share. So divided by 1 into 3. 3 shares are issued for 1. So cancel, divide by 1 and 3 shares, 30 million. That means combined number of shares is 70 million. Okay, so you can proportionate that is 179.36 million is the value of combined company for 70 million shares. So you can split for 40 million shares that goes in Joshua's account, and for 30 million shares that goes in Fraser's account. So equity value after acquisition for Joshua shareholders will be 179.36 million is the total equity value of the combined company, right? And divide by 70 million shares. This is the per share value of the combined company. Okay. And Joshua shareholders will have 40 million shares. Okay. And similarly, 179.36 million is the combined company value. Per share is divided by 70. Okay, combined number of shares is 70. And Fraser shareholders will only have 30 million shares. Okay. And now you can find the percentage change in equity value for both companies by taking the difference. Okay, so difference B44 minus B43. Divided by the base B43. And for this, it's C44 minus C43 divided by C43, 37%. This is the percentage in equity value for both companies. Okay, so equity value before acquisition and equity value after acquisition was compared. For after acquisition, we have the combined company. We divide by combined company shares and split it to Joshua and Fraser shareholders. Okay. पता है कुछ लोग Okay, now there is one more requirement in this. That is, you have to compare percentage in equity value and the next year's dividend income. Now, percentage change in next year's dividend income. That will also be calculated in the same manner like you did percentage change in equity value by comparing pre-acquisition value and post-acquisition value. Now the percentage change in next year's dividend income would be again dividend income before acquisition and dividend income after acquisition. Joshua, Fraser. Now the dividend, you have to compare two things, right? That's the requirement. Percentage change in equity value and next year's dividend income for both shareholders. Okay, so dividend income before acquisition. It's 2.7 and 3.2 given. Dividend income after acquisition, we have to find it. Post-acquisition dividend. Fraser's founder and majority shareholder is unlikely to approve an acquisition offer on terms which would lead to a reduction in dividend. However, Joshua's debt includes a covenant restricting dividend to 25% of each year's free cash flow to the firm. So dividend income is restricted by a covenant, 25% of each year's free cash flow. So in next year, the free cash flow is 19.60 million. That's the free cash flow of year one, right? 19.604 million. So next year's dividend will be 25% of free cash flow, 19.6 million. That was the figure, right? 19.604. So 25% of 19.604, 4.9 million is the next year's dividend. So what will be the dividend income for next year for Joshua shareholders? It will be 4.901. Okay. For the combined company, right? This is the combined free cash flow. Okay. So 4.901 and 70 million shares were of combined company, but Joshua shareholders only have 40 million shares, so they will get 40 shares. And similarly to Fraser, 4.901 is the dividend and number of shares are 70. But they will only have 30 million shares. Okay, so you just compare them and get the percentage change in dividend as the difference B52 minus B53 divided by B52. And here C52 minus C51 divided by C51. Okay, so let's just check how things are moving on for this. It's just the difference divided by the base, and if you convert it into percentage form, it will be 3.72 and 34.36 negative. That means Fraser's company shareholders are losing dividend income and they are gaining. Okay, please copy this. So the calculation of percentage in equity was before equity and after equity, but we split equity according to the shares, and same pre-acquisition dividend income and post-dividend income was just split according to the number of shares. Okay. Okay, now if you go on this report portion, which we started to make because we have to make a report here. So it was 2 board of directors from date and proposed acquisition. So first run account post acquisition WACC, appendix 1 shows post acquisition WACC. So post acquisition WACC was 12%. Okay. Appendix 2 shows the additional value to shareholders. So additional value to shareholders has also been found. $21.362 million. Just you can further expand it. This was calculated by comparing the post acquisition value generated by FCF method and the pre-acquisition value of both companies. Acquisition seems to be creating additional value. Okay. Now the third, shareholder wealth before and after acquisition. Appendix 3. We can name this as Appendix 3. Because this was Appendix 2. I think Appendix 1 was WACC. Appendix 2 was this. And you can name this Appendix 3. Because this is the calculation requirements. Shows that equity value has increased by 0.48% for Joshua shareholders and by 37% for Fraser shareholders. Even though equity value is rising post acquisition, still Joshua shareholders may feel they are not getting enough out of this acquisition. As far as percentage change in dividend is concerned, Joshua shareholder will get an increased dividend of 3.72%, but Fraser shareholders will suffer a loss in dividend post acquisition. So this factor may push them not to accept acquisition offer. Okay, so you are calculating as well as briefly commenting on this as well. Okay, please copy. Then there are only two requirements left. Both are theory. So then we will end this question. Okay, please copy this. Okay, now there is, I think, one last requirement left. Two requirements are left. It states that you have already calculated the shareholder wealth before and after the acquisition. Okay, here it was the case where I computed the shareholder wealth before and after acquisition and the dividend income. Okay. Now it's another requirement that states advise the board of any concerns either company shareholders may have with the acquisition. So what concerns shareholders may have with the acquisition, you have to write that, and validity of the assumptions made in part 1, 2, and 3 of B. So above 3 parts, whatever assumptions were made, we have to discuss the validity of those assumptions. And you need to advise the board of any concerns company shareholders may have with the acquisition and validity of assumptions. Okay, so this seems to be a discussion requirement. So in the main report, we have developed a good report. So we can basically continue this in a good manner that we did to from date subject introduction and post acquisition WACC and stuff like that. So recommend 4. Okay, 2 from date subject. This was requirement 1, then requirement 2, then requirement 3. We will write requirement 4. Concerns of shareholders Okay, so let's start with the requirements now, which states that you need to advise the board of any concerns either company shareholders may have with the acquisition and the assumptions. So what concerns shareholders may have with the acquisition? I think it was present in the scenario. That there has been ongoing media speculation. Joshua is attracting takeover interest. No approach made so far. Joshua's directors are concerned about the implications of their future in the company. And chairman would like to discuss defense strategies at an upcoming board meeting. Particularly suggestion that Joshua could defend itself by proving its own takeover offer for Fraser. They're improving takeover offer for Fraser, and it will be difficult to acquire an enlarged Joshua company. Then there was an exhibit 2. which stated that Joshua will earn PBIT of 27.2 million, growing by 5% per year. TAD is equivalent to amount of investment. And funding options have deteriorated significantly and no longer has the cash reserves to fund offer. Shareholders are unlikely to agree to right issue. So share for share exchange is being considered. And post-acquisition asset beta can be assumed, pre-acquisition cash flows. CEO's proposal for share exchange is that one share for 3 shares. Founder and majority shareholder is unlikely to approve an acquisition offer on terms which would lead to a reduction in dividend. Joshua's debt includes covenant restricting dividend payments to 25%. Board has therefore asked for evaluation of impact on next year's further forecast. As yet, there have been no formal takeover offers. The board wants to be fully prepared, particularly if their own takeover of Fraser is not viable. Directors have been attending series of seminars on alternative defenses, would like to discuss their findings. Topics to discuss the possibility of using share buyback as defense tactic. This will involve Joshua buying and then canceling some of its shares. CEO has asked for advice on credibility of such defense. So you need to advise the board of concerns shareholders may have. So I'm writing it in points, but you need to elaborate it. The first concern shareholders may have that Fraser's takeover offer was previously rejected. They may be concerned what has changed so quickly that company Joshua wants to give offer. Again, they may be concerned about this, that we just had the scenario that we tried to acquire Fraser but weren't successful. Now, what has happened that we are again giving takeover offers? So this might be a cause of concern for shareholders, right? It was rejected on the grounds that it is not creating value. Okay. Similarly, the shareholders might be concerned about reliability of calculations. Shareholders are concerned. They might be concerned whether the calculations made or estimates made are reliable or not. This might be a cause of concern as well. Company previously offered cash, but now doesn't have cash. So going for share exchange, there might be a concern whether Fraser may accept it. Your calculations say that Fraser shareholders will earn more in this compared to Joshua. So Joshua might be concerned. Fraser might be concerned about fall in dividend income. Okay, this also needs to be taken care of. Equity value is increasing for Fraser compared to Joshua, which might bother Joshua shareholders. Dividend income fall by a huge margin may be concerning for Fraser shareholders. Fraser shareholders might be concerned on 143 offer as situation of Joshua seems deteriorating from multiple points as well. Fraser is on growth, Joshua is declining. So Fraser shareholders might also be concerned whether we are being acquired by a company who itself failed to protect itself against competition. Okay, so Fraser shareholders may be concerned on management styles as it led to decline in Joshua's position. You can elaborate this because I'm just writing the point. I cannot write all of these word by word. Like Joshua's position has declined. That means their management failed to secure their brand. So Fraser shareholders may be concerned that we are going in this company. Our brand may also collapse. So this can be some of the arguments, but these are concerns of shareholders. Now, what are the validity of assumptions? Following assumptions were made in B1, B2, and B3. You have done these type of requirements many times regarding assumptions, so you can write the assumptions and then elaborate them a bit. Post-acquisition asset beta is assumed to be weighted average of pre-acquisition asset betas weighted in proportion to market values. Okay. So you can write post-acquisition asset beta is assumed as weighted average of pre-acquisition asset betas weighted in proportion to market value of equity. How this assumption was reached needs to be defined in detail. You can write further as post-acquisition asset beta can be weighted average of pre-acquisition asset betas weighted in proportion to total market value of debt plus equity. So how this assumption has been made needs to be dealt in detail, because you are discussing validity of assumptions, whether it is valid or not. So you need to put questions as well. PBIT growing by 5% per year, how this has been assumed. Okay, TAD equivalent to working capital, this is also an assumption. Free cash flow growing by 3%. Post-acquisition debt to equity ratio will be maintained at 30/70. This is also an assumption. Post-acquisition debt to equity ratio at 30/70. Currently, the company's gearing is very high, because you need to put questions as well, right? validity of these assumptions are required. So you need to put questions as well. Currently, gearing of Joshua is very high. How can it make it 30%? Needs to be analyzed, as it doesn't seem valid. Because you were asked to discuss the validity of assumption. So you have assumed that debt equity ratio will be maintained at 30/70. Seems invalid because the question already states that companies is close to breaching covenants. So gearing is very high. So how will you keep it 30%? Seems to be an invalid assumption. Similarly, FCF growing by 3% in perpetuity. Okay, you need to question this assumption as well. How the company reached TAD will equal working capital. Okay, this needs to be questioned. So validity of assumptions, 5, 6, 3, 4 assumptions. This can help you secure. How many marks were there? 8 marks. Okay, so you can please note these points. I am constantly saying after every tutorial question, after my explanation, do read the examiner answer so that you get an idea of how things go for you. So when you have the points of me and read the examiner answer, this helps you. Okay, now let's move to the last requirement. Discusses the credibility of CEO's alternative suggestion to use a share buyback as a takeover defense and advise whether this is a feasible strategy. This relates to the last paragraph. As yet, there have been no formal takeovers offered for Joshua. However, boards want to be fully prepared in case this changes, particularly if their own takeover of Fraser is not viable. So there is no takeover offer for Joshua, but board wants to be fully prepared, particularly if Fraser is not viable, because what they plan initially, they plan to acquire Fraser so that Joshua becomes an enlarged company and gets difficult to acquire. But they are thinking of getting prepared in case takeover of Fraser is not viable, because if takeover of Fraser is not viable, you can't take over Fraser, then you won't become enlarged and somebody can still acquire you. So they want to be fully prepared. The directors have been attending a series of seminars on alternative takeover defenses and would like to discuss their findings at the next week's board meeting. The topics to be discussed include possibility of using a share buyback as a defense tactic. Now, what is a share buyback? You buy your own shares. Company buys its own shares. This would involve Joshua buying and then canceling some of its own shares. Joshua CEO has asked for your advice on the credibility of such a defense and would like to discuss the effect on companies' EPS, cost of capital, and share price in the context of companies' liquidity problems and further bank covenant, which has imposed a restriction of what assets can be disposed of. Okay. So CEO has asked for your advice on credibility of such defense, the buyback. Would like to discuss the effect on companies' EPS, cost of capital, share price, in the context of liquidity problems and further bank covenant, which has imposed a restriction on what assets can be disposed of. There is a bank covenant, also further covenant. It has imposed a restriction on what assets can be disposed of. Bank has set another condition on disposal of assets. Okay. So CEO wants your advice. Okay. Now, what's the requirement? Credibility of suggestion to use share buyback and advise whether this is not a feasible strategy. Okay. Now, last requirement, B5. Credibility of share buyback. Joshua is considering a suggestion to buy back and cancel its shares as a defense tactic. Buying back and canceling own shares will result in less number of shares in market. So even if anyone acquires those shares, they can never get controlling interest in company. Okay, you are buying back and canceling your shares. Now, once directors buy back the shares, buy from public, that means public now, market now has less shares. So even if someone buys those less shares, they cannot get the controlling power. If your all shares are in the market, someone acquires shares from the market, they get a controlling interest. But if you buy back and cancel those shares, now there are less number of shares in the market. So even if someone gets those less number of shares, they can never ever get the controlling interest. Okay. Buying and canceling shares will reduce equity, shares less reduce equity, which will increase earning per share. Okay, less equity means less shares. So PAT less preference dividend divided by number of shares. Less shares means more increased EPS, as well as less number of shares may increase share price. When there are less shares in the market, this may increase share price. High share price may also prove as a defense. Class. High share price may also prove as a defense, because if share price goes high, then definitely high share price means the people who were interested to buy you, they say, oh, now the share price is higher, they go back. Okay. So theoretically speaking, this can be a good defense, but practically buying back its shares requires funds. Company does not have company doesn't have the cash reserves, because buying back shares you will buy from public, it requires money, you don't have cash. Plus, it can also not raise cash via debt, as its gearing is already very high. Another way to raise cash is disposal of asset, but as mentioned, there is a restriction on disposal of asset as well. Remember, in the last line there was a covenant. Fall in equity will further increase gearing, leading to loss of confidence among shareholders. This can increase our cost of capital, because high gearing may make it difficult to obtain finance. So we have to get finance at a higher cost of capital because we have become more risky. And this can end up with fall in share price, because high cost of capital, lack of confidence may result in fall in share price. So in this case, it does not seem to be a feasible proposal. Okay, we have done this requirement of 5 marks. Please copy this as under this question with a report. Take care.